Chapter 1: Corporations and Goals of Corporations. Following are the learning outcomes from this chapter. After going through this presentation, students will be able to compare and contrast between investment decisions and financing decisions. Compare and contrast the different types of firms that can exist and with respect to their financial decisions they make. Analyze the difference between finance departments inside a firm as well as the different financial managers that exist in the firm, and identify the agency problem. So, what is an investment decision? An investment or a capital budgeting decision is a decision to create or invest in real assets which are tangible or intangible. So tangible assets could be something like a plant and machine or furniture or a building, and intangible assets could be something like patents, trademarks, and copyright. These are all capital budgeting decisions because investment in these would be spread typically across some point of time. The financing decision, on the other hand, is investment in financial assets, which is against future cash flows, which means that, for example, when a bank is giving a loan to a customer, they are trading today's money for future cash flows. So the person who's borrowed the money will repay the bank in installments in the future. So a financial asset is created that way. A financial asset will usually require some kind of a borrowing and some kind of promised future cash flows. So let's identify some investment and financial decisions here. So a towing company decides to spend $500 billion to develop a new prototype aircraft. Now here we talk about $500 billion being invested inside the creation of designs of an aircraft. So it's an investment decision. TME borrows $400 million from bond investors. Now there's no mention of what is being done with the money. So therefore this is going to be called as financing decision. Microbig issues 100 million shares to buy a small technology company. Again, here shares are being issued, so we have some insight into the financing part, but we really don't know what is going on or what is the amount of money. But even then, we know that there will be shareholders who will be given a lien against these shares. So this has an element of financing decision, but the most important part is it's going to buy a small technology company, which is an investment decision. So it's acquisition of that technology company, which is a real asset. What is a corporation? A corporation is an organization that functions for its shareholders, and shareholders are owners of a company, or at least partial owners of a company. All they are interested from a corporation is its profits. They don't care about who the managers are, what the managers do, as long as the company is profitable and gives them some kind of cash flows. There are different types of companies. The first company is a proprietorship or a single owner company. The other is a partnership in which there could be one or more joint owners of a company. Now the problem with proprietorships and partnerships is that income from the company would be the income for the individual or the owner, and therefore it's treated as personal income. Sometimes that is a problematic thing, because if there is a problem with the company, the liability becomes infinite. To avoid that, usually owners form a corporation. So there could be a limited liability company, for example, in which there are owners, joint owners, but each owner has only a limited liability, for example, lawyer's office or a doctor's office. And then there's a public entity called as corporation, which is publicly traded shares and is owned by shareholders. However, an incorrect decision made by the company is definitely not bound on the shareholders. It's bound to the company. The advantages of forming a corporation are corporations have reputations, as more reputation as compared to most individuals. So capital can be raised more easily. Liability is limited. If a corporation makes mistakes, then the shareholders are only liable by a limited amount. And the most important thing is individuals have lives which is fixed. And corporations could potentially function for a long period of time. Some examples are General Electric and IBM. The problems with a corporation are tax liability. So what happens is a corporation earns profits, but the profits are taxed, and so taxes are paid to the government. After the taxes are paid to the government, the remaining profits are sent out to shareholders potentially as dividends. Dividends are considered income for the shareholders or owners, and they, owners, have to pay that tax on that dividend income once again. So there's a problem of double taxation. Not only does the corporation pay taxes, but the owners, when they receive dividends, are also forced to pay taxes. Now let's compare this with interest received on bonds. Let's assume a shareholder, instead of investing in shares, invests in bonds. So when they earn interest income from the company, the interest is charged. Taxes are charged on interest. Taxes are accrued on interest. But the corporation has to pay the interest before it pays the taxes. So in other words, corporations don't have a tax liability on interest expense. So there is no double taxation in case of bonds, but there is a problem of double taxation in case of shares. Last but not the least is the problem called agency problem. Managers usually work for their own interest. In other words, they're trying to get a promotion or better salary, and in other words, they're trying to save their job. But the company's interest may not match up with that. A company's interest is maximizing the value for shareholders, either through a greater stock price or through greater dividends. And in the short run, managers' interest could be wildly different than the company's interest. So the goals of a corporation really are to build the shareholder value. And what is the opportunity cost of not paying dividends to shareholders? Companies such as Netflix, Amazon, and in the early years, that is early 2000s, Apple was not paying dividends to its shareholders, but keeping all of the profits and using them for future investments in the corporation. These companies are called growth stocks. On the other hand, today's Apple company in 2023 is aggressive on paying dividends, as is Microsoft, etc. So these companies now pay shareholder dividends and are therefore, for shareholders, these are income stocks. So inside the company, who makes these decisions of what projects to acquire, what is the value of these projects, what is the size of the company, how many assets and liabilities does the company have? So there are three types of macro level managers inside a company. They are the CFO, the treasurer, and the controller. So the CFO governs the financial policy. He's the supervisor of the treasurer and the controller, and the CFO or she is a supervisor, and the CFO is answerable to the CEO of the company. So CFO would be making those financial decisions and in return be answerable to the CEO of the company, and sometimes even shareholders and board of directors. The treasurer works for day-to-day cash positions of the company, in other words, liquidity position of the company, which is critical for the survival of short-term functioning. And this treasurer is also involved in raising of capital, either through merchant money markets or through capital markets, which we'll discuss in the next chapter. The CFO, if there's surplus cash, the treasurer will be involved in short-term investing. The treasurer will be having relationships with market participants who can potentially borrow and lend money from the corporation. On the other hand, a controller prepares the financial statements, is involved in accounting and audit of the company, and also ensures appropriate payment of taxes to the government, state, local, and the federal governments. So these are the financial managers of a company. Now, the financial manager is intricately involved in raising funds from investors through what is called as the financial assets in order to create real assets for the company. The financial manager could potentially be involved in agency problems. In other words, something that's good for the financial manager may or may not be good for the corporation. So that is one thing that we must be careful about when a financial manager operates. So once again, agency problems are increasing the shareholder wealth is the main goal of a corporation. This shareholder wealth can be created through bigger dividends or increasing the share price. And financing decisions are also objective of a financial manager. Now, these goals could change from time to time dynamically and be different for the corporation as compared to the manager, and that is the agency problem. So these different objectives among stakeholders are some of the root causes of agency problems. Like shareholders need higher stock price and greater wealth. Middle to lower level managers concentrate on their own growth and remuneration. Top managers are more concerned about the company reputation. Banks and lenders just are interested in timely payments of their loans. And non-coordination of these goals within the company or outside the company can lead to agency problems. What are the solutions for agency problem? Well, a compensation that could be linked with share price for managers through stock options or performance linked with profitability of the corporation could be one solution. So the board of directors and block holders could have a bigger say in the way a company operates. And we've seen several examples in markets on that. Sometimes big block holders acquire large amounts of shares in a corporation just in order to make sure that the company is reformed and operates to the biggest ability in order to maximize shareholder wealth. If that doesn't happen, the company could be taken over by another company, or there could be a specialist monitoring of how the managers operate. And there are legal and regulatory requirements such as reporting of balance sheet and income statement every typically every quarter to the Securities and Exchange Commission that can also solve partly some of these agency problems. And that's chapter 1. Thank you for listening.